Right, so welcome to another deep dive. This time we're tackling Lowell's The Single Best Investment, Creating Wealth with Dividend Growth.
Mm.
And as always, we're not just going to summarize the book, but really dig into the core of his strategy, the logic behind it, and see if it actually lives up to his, kind of bold title.
And what I find really interesting is that Miller, right off the bat, kind of challenges conventional wisdom. He goes straight for bonds, and you might be surprised he doesn't exactly sing their praises.
No, he doesn't. He just straight up calls bonds a bad investment. He even says that in the long run, they're riskier than stocks. Now, that's a pretty provocative statement for those who see bonds as, this cornerstone of a balanced portfolio.
Yeah, he's definitely not afraid to stir the pot. But when you listen to his reasoning, it does give you pause. I mean, bonds, they rarely outpace inflation, right? So that means the purchasing power of your money is just slowly dwindling over time. It's like watching your savings just kind of melt away.
Yeah, it's like the ice cube on a hot summer day. He uses this example. I thought it was a great one. Imagine putting away $10,000 in 1945,
Yeah.
like for your kid's college, right? And back then, that was enough to buy like a small house. But fast forward to the mid-60s, and that same $10,000 could barely cover a single year of tuition.
Exactly. It really highlights that impact of inflation. It's silent, it's devastating. And stocks, yeah, they go up and down, but Miller calls it a bouncing principle. And in the long term, their potential for growth just blows fixed income out of the water.
Okay, so bonds are on the back burner for now. But where does this single best investment come in? I mean, Miller seems to think he's found the holy grail of wealth building. So I got to know.
Well, he pins a lot on something we've all heard of but maybe don't fully appreciate: compounding.
Compounding. That word gets thrown around so much in the investing world. Yeah, it's supposed to be this magical force that grows your wealth, but it's always kind of felt a bit abstract.
Yeah, it can be a bit hard to wrap your head around at first, but it's truly remarkable. Basically, your money earns interest, then that interest earns more interest, and so on and so on. It creates this snowball effect. Miller actually has this mind-blowing example. He says just $24 invested way back in 1626, earning a steady 10% interest every year, would theoretically be worth enough to buy the entire world today.
Whoa, okay, that's a powerful image. But let's be real. Most of us don't have 400 years to just sit around and watch our money grow.
Of course, that example, it's just to illustrate the power of compounding over centuries, right? But even over a shorter time horizon, like a typical investing lifespan, the principle still holds true. It's incredibly powerful. And here's where it gets really interesting. Even if you need to, spend some of your returns along the way, you can still harness compounding by investing in companies that are themselves built for growth.
So instead of just earning interest in a savings account, we should be looking for companies they're designed to multiply their own value over time, almost like they have their own little compounding machines built in.
Exactly. And that leads us right to the heart of Miller's strategy: building your own personal compounding machine powered by a very specific type of investment.
Okay, all right, so let's get into the nuts and bolts here. What exactly is this compounding machine made of?
Well, the engine of this machine runs on high quality, high yield stocks. And the key here is they have a solid history of dividend growth. And when I say dividend growth, I mean consistent year over year increases in those payouts.
Dividends are key, but I got to be honest. I've always been kind of confused about dividends. Are they really that important? I mean, they always seem kind of small compared to the overall stock price.
Don't underestimate the power of dividends. They are much more than just a little bonus. Think of them as a company's report card, a tangible sign of its success in the real world. When a company consistently pays dividends, it's telling you, hey, we're profitable, we're financially healthy, and we're committed to sharing our success with you.
So it's not just about hoping the stock price goes up. It's about seeing a company's actual performance, like real, tangible results.
Exactly. And consistent dividend growth, not just a one-time payment, that's what acts as the turbocharger for your compounding machine.
Yeah.
You're not just receiving a steady stream of income, but a stream that's increasing year after year after year.
Okay, yeah, I'm starting to see how these dividends fit into this whole compounding machine concept. But finding companies with a consistent history of dividend growth sounds like, I don't know, it sounds like a lot of research.
Well, don't worry. Miller lays out a pretty clear roadmap for identifying those single best investment candidates. And it's not about risky bets or chasing fads. He advocates for a disciplined approach, one that focuses on businesses with specific characteristics that signal long-term strength and stability.
All right, lay it on me. What are we looking for here? What are the hallmarks of these ideal companies?
First off, you want companies with rock-solid balance sheets, low debt, ample cash flow. This translates to financial flexibility. It means they can weather those economic storms. You don't want to invest in a company that's drowning in debt.
Makes sense. I mean, a company that's struggling to stay afloat isn't going to be sharing its profits.
Exactly. Second, you want companies with proven management teams. These are the folks at the helm, right? They're making the big decisions, guiding the company towards long-term growth. You want to see leaders with a track record of smart choices, not just lucky breaks.
So we're not looking for companies that are just riding a wave of good fortune. We want companies that are well run from the top down.
Okay.
What else?
Miller also talks about a durable, competitive franchise. It's like a company's unique advantage in the marketplace, their secret sauce. Could be a brand name, dominance in a specific industry, a niche expertise. You want companies with that built-in edge, something that can withstand challenges and adapt to change.
It's like finding those businesses that have a moat around their castle, protecting them from competitors and market disruptions.
Perfect analogy. That moat can take many forms, right? Think Coca-Cola, their global brand recognition, or Google's dominance in search. Companies with staying power, that's what we're after. That's what's essential for long-term investment success.
So, strong financials, capable leadership, a competitive advantage. So far, so good. But I'm guessing there's more to evaluating a company than just those three factors. Don't we also need to think about the market, the company's future prospects?
You're absolutely right. Numbers don't tell the whole story. Every company has a narrative, a future trajectory that investors buy into. Miller suggests going beyond the balance sheet, really understanding a company's growth potential, its ability to create value over time.
It's not just about analyzing the past, it's about understanding the future.
Exactly. And Miller, he talks about certain growth kickers that signal a company's future potential. Think of them like catalysts that can propel a company's growth beyond its current state.
I like the sound of those growth kickers. Give me some examples. What should we be looking for?
Well, one example would be a company developing a new division or product line with breakout potential. It's about finding those businesses that are not content with the status quo. They're actively expanding, exploring new areas, new possibilities. Think about GE Capital, for example. Started as just a financing arm for appliance dealers, and it grew into this financial powerhouse in its own right.
Okay, so we're looking for companies that are innovating, expanding, finding new ways to generate value. Got it. What are some other growth kickers to watch out for?
Well, another good sign is a company that's making strategic acquisitions in a fragmented industry. And I'm not talking about just buying companies randomly. They're consolidating their position, gaining market share. This can fuel significant growth. Think Waste Management or Blockbuster in their early days. Strategically acquiring smaller companies, building their empires.
It's like they're putting together a puzzle, piece by piece, to create a dominant force in their industry.
Exactly. And those pieces need to fit together strategically. Creating synergy, creating value. Another growth kicker, share buyback programs. That's when a company uses its profits to buy back its own stock. This boosts earnings per share, increases the value of remaining shares, and signals that management believes the company is undervalued.
It's like the company is betting on itself, which can be a reassuring sign for investors.
Right. A share buyback program demonstrates their confidence. And then, of course, there's riding a powerful economic tailwind. A broader trend that creates this huge demand for a company's products or services could be a demographic shift, a technological advancement, a change in consumer behavior. Think about a company like AMP. They rode the wave of electronics growth by specializing in electrical connectors. Small but essential component in a booming industry.
It's about finding those companies that are not just good at what they do, but they're also well-positioned to capitalize on these larger forces that are shaping the market. It's like surfing a wave, right? You use its momentum to propel you forward.
That's a fantastic way to put it. It's about recognizing those companies that have the wind at their backs, pushing them towards continued success.
Okay, so we're really digging deep into these companies, going beyond the numbers to understand their growth potential, the overall narrative. But even with all this analysis, I'm guessing there's still an element of uncertainty when it comes to investing, right? I mean, we can't predict the future.
Of course, no one has a crystal ball. But Miller, he does see value in technical analysis, specifically charts, as a tool for making more informed decisions, especially when it comes to the timing of purchases.
Charts, huh? Isn't that getting into day trading territory? That whole market timing thing that everyone says is impossible.
It's a common misconception. Technical analysis can be easily misinterpreted, but Miller believes charts can provide valuable clues, especially when it comes to identifying, you know, opportune moments to buy into a company's long-term story.
So we're not talking about predicting every little market swing. We're talking about using charts to spot potential buying opportunities, opportunities that align with our overall strategy.
Precisely. It's another tool in the toolbox, helping us make those more informed decisions. Miller actually points to a particular chart pattern that he finds particularly useful. Stocks that have shown at least 6 months of relative weakness, followed by a noticeable uptick in strength.
So we're looking for stocks that have been overlooked or undervalued by the market and are starting to gain momentum.
Exactly. It's like finding a hidden gem that's starting to sparkle. But remember, charts are just one piece of the puzzle.
Right, another data point, not the whole picture.
Exactly. We should never get too caught up in those short-term fluctuations or rely solely on charts for our decisions. Our focus, the real focus, should always be on the long-term prospects of the company, how its story aligns with our goals.
Okay, so after all this analysis, after all this digging deep, do we have a clear picture of what a single best investment stock looks like? Can we boil it down to a checklist?
Absolutely. Miller gives us a pretty concise set of rules for identifying those prime candidates. First and foremost, high quality, meaning they meet those criteria we discussed. Strong balance sheet, proven management team, durable competitive franchise. Then we layer on high yield and high dividend growth potential, the twin engines of our compounding machine.
Got it. Those are the core components that drive that long-term growth. But what about price? We don't want to overpay for even the best company in the world.
Absolutely. That's where valuation metrics come in. You want to make sure the stock is priced attractively relative to its earnings, its sales, its assets. There are a number of ratios that can help you assess whether a company is overvalued or undervalued.
So it's not just about finding a great company, it's about buying it at the right price. The
Hmm.
numbers got to make sense.
Exactly. And finally, you want to make sure the company has a compelling story of future prospects backed by those growth kickers we discussed earlier. Remember, we're not buying a company's past performance, we're investing in its future potential.
It's a three-legged stool. You got strong financials, a good story, a track record of dividend growth. Seems like a solid foundation. But I'm guessing the real test is how these single best investment stocks perform in the real world. Does Miller give us some specific examples?
He does. And in the next part of our deep dive, we'll walk through some real-world examples. We'll see how these principles play out, examine their performance, analyze their stories, and see how they fared in this ever-changing landscape of the stock market.
This is getting really good. I can't wait to see how this strategy actually plays out. Stay tuned, folks, and we'll be right back. Welcome back to our deep dive into Lowell Miller's single best investment. Before the break, we were just getting into what makes a company worthy of that title right.
Mm-hmm.
You know, those high-quality, dividend-paying businesses, the ones that just have a knack for growth. And we even tease some real-world examples, like Questar and their intriguing hidden growth story.
It's always fascinating to see how these principles actually play out in the market, but finding those promising companies, well, it's just half the battle, right? We need to figure out how to actually build a portfolio, one that's not just profitable, but also designed to weather, those inevitable market storms.
That's where portfolio construction comes in, right?
Mhm.
It's about more than just picking individual stocks. It's about strategically assembling them, creating a well-oiled machine that's designed for the long haul. So what does Miller suggest?
Well, he really emphasizes a portfolio structure that not only maximizes returns, but also minimizes risk, minimizes volatility. And he actually does this by challenging some pretty common assumptions about the role of bonds.
Hold on. Are we going back to that whole bonds are bad argument? I thought we settled that.
Not quite. Miller acknowledges that bonds, they have played a significant role in portfolio construction in the past, especially back when interest rates were more stable, right?
Hmm.
Back when bonds offered this reliable way to kind of smooth out those portfolio bumps.
I can see how that would make sense.
Yeah.
Bonds are often seen as this safe haven asset, a way to counterbalance those ups and downs of the stock market.
Yeah, that's been the conventional wisdom for a long time. But Miller argues that this traditional approach, this needs a serious reevaluation. He points out that over the last 2 decades, the yields on T-bills, those supposedly risk-free investments, have actually shown more volatility than the stock market.
Seriously. But T-bills are backed by the government. They're considered one of the safest investments out there. How can their yields be more volatile than the stock market?
It's an eye-opening statistic, right? While the principal value of T-bills might stay relatively stable, The percentage change in their yields has been, well, it's been pretty dramatic in recent years. This means the income you receive from those bonds can fluctuate significantly, especially in an environment where interest rates are constantly changing.
Okay, so if we can't rely on bonds for that smooth ride in our portfolio, what's the alternative? How do we reduce volatility? How do we build a portfolio that can actually withstand that market turbulence?
Miller's answer: a different approach to diversification. One that focuses on the inherent strength and resilience of those single best investment stocks, the ones we've been discussing.
So instead of diversifying across different asset classes like stocks and bonds, we're diversifying within the stock market itself.
Exactly. And remember, these aren't just any stocks. We're talking about companies with fortress-like balance sheets, experienced leadership, durable competitive advantages. These are businesses designed to weather those economic storms, emerge stronger on the other side.
It's almost like building a portfolio of, I don't know, of mini fortresses, each one capable of withstanding its own share of market pressure.
That's a great way to think about it. And Miller suggests aiming for a portfolio of at least 30 to 40 of these single best investment stocks. To achieve that sufficient diversification, reduce the impact of any single company on your overall portfolio.
30 to 40 stocks. That sounds like a lot to keep track of, especially for someone who's not a professional investor. Is there a sweet spot, a number that provides like adequate diversification without being too overwhelming?
There's no magic number. But Miller's research suggests that for most investors, a well-chosen portfolio of around 15 to 20 stocks can strike a good balance between diversification and manageability.
Okay, that feels a little bit more doable, at least for someone like me. But once we've identified those 15 to 20 companies, how do we decide how much to invest in each one? Do we just spread our money evenly?
Miller recommends a surprisingly simple approach: equal dollar weighting.
Equal dollar weighting. What's that?
It means investing the same amount of money in each stock, regardless of its price. So if a stock is trading at, say, $50 or $500, you'd allocate the same dollar amount to each position in your portfolio.
That's interesting, but why would you invest the same amount in a $50 stock as you would in a $500 stock? Wouldn't you miss out on potential gains by underweighting those more expensive stocks?
It might seem counterintuitive, but this approach is really rooted in the idea that we can't predict with certainty which stocks will perform the best. By equally weighting, you're acknowledging that you don't have a crystal ball. You're avoiding the risk of over-concentrating in any single company, regardless of its price or, its perceived potential.
So instead of trying to pick winners and losers, we're creating this balanced team, a team of strong contenders.
Exactly. Think of it like assembling a sports team. You don't just want one star player. You want a well-rounded roster, a mix of talent, each contributing to the overall success.
I like that analogy.
Mhm.
And with equal dollar weighting, we're diversifying our risk even further because we're not betting too heavily on any single company, no matter how promising it might seem at the moment.
Precisely. It's a strategy that acknowledges that inherent uncertainty in the market. It aims to mitigate risk by spreading your bets.
Okay, so we're building a diversified portfolio, 15 to 20 high-quality dividend-paying companies. We're investing the same amount in each. But what if we have, a specific goal in mind? Let's say we're mainly focused on generating income, like to supplement our retirement. How do we tailor this strategy?
That's a great question. Miller recognizes that investors, they have different objectives, different risk tolerances. He suggests that if your primary goal is income, you can tilt your portfolio towards companies with even higher dividend yields.
So instead of just looking for, companies with that consistent dividend growth history, we're prioritizing the ones with the juiciest payouts right now.
Exactly. You're aligning your portfolio with your specific goals. Now, focusing on those higher yielding stocks, that might mean you sacrifice some potential for capital appreciation, but it can provide a more reliable, a more consistent stream of income. And that can be particularly appealing for, retirees or those seeking to supplement their current earnings.
Makes sense. It's about finding the right balance,
Right.
right, between growth and income, depending on your needs, your circumstances.
Exactly. Investing, it's not one size fits all. It's about finding what works for you.
Okay, so we've covered how to find those standout stocks. We talked about building a diversified portfolio. We even touched on tweaking that portfolio to align with specific income goals. But let's be real. Investing, it's not just about numbers and spreadsheets, right? It's also about psychology, about discipline. It's about managing those emotional roller coasters that come with riding the market.
You're hitting on a really crucial aspect of successful investing. It's not just the mechanics, it's mastering the mental game.
Exactly. So how does Miller address this human side of investing?
Well, he actually dedicates a good chunk of his book to this very topic. He stresses that one of the biggest challenges for investors is holding on to those single best investment stocks for the long haul, even when the market, throws its inevitable tantrums.
That's easier said than done. It's just human nature to get spooked when the market takes a nosedive.
It absolutely is. But Miller encourages investors to adopt what he calls a landlord mentality.
A landlord mentality. What does that have to do with investing?
Think about it this way. When you own a rental property, your primary focus is on that steady stream of rental income, not the daily fluctuations in the property's value, right? You're not constantly checking Zillow, sweating over every little price change. You're more concerned with collecting the rent, keeping your tenants happy, maintaining the property for the long term.
Right. You're not letting those short-term fluctuations distract you from the bigger picture, from
Yeah.
that steady stream of income.
Exactly. That's the same mindset Miller wants investors to have. Focus on those reliable dividend payments. Those are your rent checks. Don't get distracted by those daily ups and downs.
It's about tuning out the noise, focusing on the fundamentals, remembering why we invested in these companies in the first place.
Precisely. It's about trusting the process, trusting the power of compounding. He even suggests visualizing your portfolio as this physical entity, a compounding machine that's just steadily working in the background, generating wealth even when you're not actively managing it.
That's a powerful image, like setting the machine in motion and just letting it do its thing, resisting the urge to constantly tinker or panic when things get bumpy.
Exactly. That trust, it's built on a solid foundation, on research, on analysis, on the understanding that high-quality companies, the ones with a history of dividend growth, they tend to do well over time, regardless of those short-term market blips.
Okay, so we're adopting this landlord mentality, we're holding on for the long haul, but how do we know when it's actually time to sell a single best investment stock? What are the red flags?
Well, Miller emphasizes that the primary reason to sell one of these stocks is when a company stops increasing its dividend, or if the payout ratio, that becomes unsustainable.
So if that dividend growth engine starts to sputter, if the company seems to be struggling to maintain those payments, maybe it's time to reconsider.
Exactly. It could be a sign that the company's fundamentals are weakening, their future prospects aren't as bright, but he cautions against selling solely based on a stock's price, especially if the underlying business is still healthy.
I can't see how that would be tempting, though, especially after a big jump in price. Hard to resist locking in those gains.
It certainly is. But remember, we're playing the long game here. Selling too early can prevent you from, realizing the full power of compounding. Miller reminds us, every decision to sell, it presents an opportunity to be wrong. And the fewer decisions you make, the better, especially when your investments are performing as expected.
That's a good point.
Yeah.
It's easy to get caught up in the excitement and make, those impulsive decisions. It sounds like patience and discipline. Those are really key virtues for anyone looking to implement this strategy.
Absolutely. And that brings us to a really crucial part of Miller's approach, developing a warrior mentality when it comes to investing.
A warrior mentality. I don't know. I don't really see myself as like a financial warrior, charging into battle on Wall Street.
Think of it less as a literal battle and more as a mindset. It's about embodying discipline, resilience, and unwavering focus on those long-term goals. It's about recognizing and overcoming those psychological traps, the ones that can sabotage even the most well-intentioned investors.
So it's about resisting those emotional urges, like panic selling when the market dips or chasing those hot stocks that everyone else seems to be buying.
Exactly. It's about sticking to your plan, trusting your research, weathering those inevitable market storms with resolve.
That sounds powerful.
Yeah.
But how do we cultivate this warrior mentality?
That's what we'll be diving into in the final part of our deep dive. We'll be exploring those psychological pitfalls, the ones that can really derail our investment journey. And more importantly, we'll uncover strategies for developing that mental fortitude to stay the course, make those rational decisions, and achieve our long-term goals.
This is getting really exciting. We're not just learning about investment strategies, but about how to master our own minds. And that's a powerful skill in any aspect of life, not just investing.
Welcome back to our deep dive into Lowell Miller's single best investment. We've covered a lot of ground, haven't we? From spotting those standout companies to building that powerful portfolio to, cultivating that landlord mentality to just ride out the market's inevitable ups and downs. We have. But as you mentioned before the break, there's another layer to Miller's approach, the psychology of investing. Because even with the best strategies in place, well, those emotional currents can still kind of pull us off course if we're not careful.
It's true. We can have all the knowledge, all the tools, but if fear or greed takes over, well, it can just sabotage your best efforts.
Yeah.
So how do we actually build that warrior mentality we were talking about? How do we become, I don't know, like the unshakable oak tree in the middle of the storm?
Miller offers some really insightful guidance. He starts by addressing what he calls information addiction.
Information addiction.
Yeah.
I think we can all relate to that one these days. I mean, we're bombarded with news, opinions, predictions, especially when it comes to, the financial world.
It's true. It's like we have this fire hose of information pointed right at us, but Miller argues that this constant influx, it can actually be detrimental.
Really? But isn't more information, isn't that always better? Shouldn't we be staying informed?
It's not about ignoring information altogether. It's about being selective, discerning. Because this constant barrage, especially the sensationalized stuff, that can lead to anxiety, second guessing, impulsive decisions that go against our long-term strategy.
Yeah, it's like trying to drink from a fire hose, right? You end up feeling overwhelmed, confused, not empowered or informed. I've definitely felt that panic before, like when the headlines are all doom and gloom talking about market crashes or the latest hot stock tip.
It's a common experience, and it often leads to what we call emotional investing, buying and selling based on fear or greed rather than, rational analysis.
So how do we break free from this information addiction? How do we become more discerning?
Miller suggests a shift in focus. Instead of chasing headlines, we should focus on deeply understanding our investments, the companies, their industries, their competitive landscape, their long-term prospects.
So it's about quality over quantity.
Mm.
Instead of skimming a dozen articles, we dive deep into the information that really matters.
Exactly. The most valuable information is often the simplest. Is the company growing its earnings? Are they increasing their dividends? Are their financials solid? Is the management team executing? These are the questions that reveal a company's true potential.
Those are the core indicators of a company's health, the things we should be paying attention to, not the daily noise.
Precisely. And another psychological trap, the tendency to extrapolate, taking past performance and projecting it into the future.
Like assuming that just because a company's done well in the past, it's guaranteed to keep doing well.
Exactly. It's human nature to look for patterns,
Yeah.
to assume that what's happened before will just continue to happen. But in investing, past performance, it's never a guarantee.
Yeah, I've fallen into that trap before. It's easy to get swept up in the excitement of a stock that's been, on a hot streak. But as you said, past performance, it's just one data point, not a crystal ball.
That's right. Companies can stumble, industries can change, unexpected events can happen. That's why it's crucial to continuously monitor your investments, reevaluate their prospects, and be willing to adapt your strategy as needed.
So it's not a set and forget it approach. We need to stay engaged, informed, and adaptable. What are some other psychological pitfalls to watch out for?
One of the most powerful emotional forces in investing, the fear of loss. Studies show that the pain of a loss is actually greater than the pleasure of an equivalent gain.
I can definitely relate to that. That feeling of panic when you see your portfolio shrinking and you're tempted to just, sell everything and just stop the bleeding.
It's a natural reaction, but it often leads to bad decisions. When we sell out of fear, we lock in losses and miss out on potential rebounds.
So how do we overcome that fear? How do we make those rational decisions, especially when it feels like everything's falling apart?
It goes back to that warrior mentality. Remember, market fluctuations, they're inevitable. They're part of the game. It's about weathering the storm, staying focused on your long-term goals, remembering that those single best investment companies you've carefully chosen, they're built to withstand those challenges.
Like riding a roller coaster. Right. There are going to be ups and downs, twists and turns. But if we keep our eyes on the horizon, if we trust that the ride will eventually come to an end, well, we can enjoy the journey a lot more.
Perfect analogy. It's about focusing on the big picture, trusting the process, remembering that those short-term dips, they're often buying opportunities, not reasons to panic.
Okay, so we got information addiction, the extrapolation trap, and the fear of loss. Those are some pretty serious hurdles. Any other pitfalls we should be mindful of?
One final trap I'd highlight, the allure of easy money. The siren song of get-rich-quick schemes that just promise effortless wealth.
The lottery ticket mentality
Yeah.
applied to investing. Yeah, I think we've all been tempted by that at some point.
It's a powerful allure, isn't it? That shortcut, the secret formula for beating the market. But the reality is